Okay, welcome to our August podcast. My name is Brett Hina from Cornerstone Private Wealth Partners, and I'm here with my partner, Dan Lesneski.
Good to be back, Brett.
Yeah, great to see you. And Dan, to be back, you were right off the steps of the plane, right?
Yep.
So my first question for you has got to be, Dan just spent some time in Italy and traveling with a 4-year-old and your newborn. You
Yep.
brought the newborn?
Yes, we did.
Oh, okay, so what does traveling with a 4-year-old and a newborn correlate with the stock market?
Well, I would say, unlike the month of July in the stock market, it was turbulent.
It was turbulent. Okay. Yeah.
But it was a great trip, and we were really fortunate to be able to bring them, but not for the faint of heart traveling with 2 small children.
Well, they'll be happy when you show them the pictures when they're adults that they were actually there. They may not remember, although Frankie may remember.
I think Frankie will. I think little Dan will be upset that we took him as an 8-month-old, but there's worse problems.
You were probably the whole time thinking, what would we be doing without the kids? Having more fun, drinking more Italian wine. So.
Absolutely. But it's good to be back. I'm excited to talk about the markets and give some thoughts on kind of what we expect moving forward as well.
Great. So let's get started. So again, the premise of our show is really to just go a little bit deeper into some of the topics that we're hearing about from clients, that clients are asking about. And we have a lot of conversations. In fact, many of our clients we speak with on a monthly basis, if not very, very, quarterly at the very least for folks. So we compile the questions that are coming in and we put those together in the podcast. And so I think we came up with really 4 themes that they're asking about this year. One would be definitely the trends that have gone on in the summer in the stock market and the economy as a whole. Definitely, clients are asking about that. Definitely the passage of the big, beautiful bill, how that impacts things. Tariffs are number 3, probably. And number 4 is all these fights that are going on in Washington. We've always had fights, but it seems very extreme lately.
Yeah, what do we have? We have Trump versus the Fed versus the Fed, Trump versus the Bureau of Labor and Statistics. So we have a lot going on. And it was very interesting. I mean, July, as far as the markets were concerned, was a pretty calm and non-turbulent month. But globally, there was a lot going on, right? We had, like you mentioned, the passage of the big, beautiful bill. We also had a lot of geopolitical events going on with, bombing in Iran and Iran threatening to close the Strait of Hormuz. We had some really, protests in Turkey. We had disruption in China in terms of their economy and manufacturing sector. So not a quiet month for the world, but certainly for the U.S. stock market.
That is true. Getting back to the fights in Washington, where I did some Googling just to have some fun. I'll put you on the spot, see if you know any of these, but if you Google, and I only know because I Googled the top heavyweight fights of all time, right? So if you go out and Google that, there's 3 that come to mind. Do you know what they might be?
Probably Ali Frazier.
Okay.
She's...
all 3 are Ali.
Well, it would be Ali Frazier, Ali Foreman.
Right.
Right. So what's that? The Rumble in the Jungle.
Right.
And then I don't know what the third Ali would be for that particular list. What am I missing?
That's a great. You're missing Ali Frazier 3. So there were 3.
Okay.
So yeah, I Googled it up, and that was great answer. And we did not prepare or talk about that, but the biggest fights or the most important fights of all time are Ali Frazier, 1971. Had to look it up. It was dubbed the fight of the century, and they were both undefeated at the time. And Frazier won by unanimous decision. Then you had 1974, Ali Foreman. That was the Rumble in the Jungle. Yep. You got that one right, too. And that was the famous rope-a-dope thing, and Ali won that one. And then third was the, probably, and some say the best of all time, was Ali Frazier 3 in 1975, and that was the Thrilla in Manila. That was the famous one. And Ali won in a TKO in the 14th. So, yeah, they were the most famous. But now we have, what about Trump versus Elon Musk, which was a barrage of tweets that came by in the summer with over that 48 hours, there was hundreds of tweets, and it was like X versus Truth Social. Yep. So I'm not a member of either, so I missed a lot of the tweets, but that was crazy. But now we have Trump versus Powell. I guess it's not really a fight because Trump is throwing all the punches there and Powell's staying out of it. But now we have Trump versus maybe the entire Federal Reserve System, and even the whole apparatus in the government for the BLS
Who
and
who
all that.
knows? Maybe Powell's sitting back and doing his rope-a-dope, right? And he's getting ready for the final round. But
Right.
yeah, it's been interesting, and even beyond the president and kind of the interesting interactions over the past month. You also have right now going on in the Senate um, another fight, right, between
Yes.
the senators that want to eliminate stock trading for all members of Congress and those that don't. And I was watching some clips of some of the exchanges between Senator Langford and Senator Hawley, and it's getting pretty contentious. And don't Rick Scott also weighed in on that pretty heavily. So it's an interesting time. There's a lot of tension in the air, but it doesn't seem to be translating on the investment front.
That's right. You're right. So in the investment front, Dan touched on it. July was the third up month in a row for the S&P 500. So we had a good, strong month. The NASDAQ also was up for the fourth month in a row. And kind of interesting what you touched on, low volatility. In fact, it was during the month of July, it was the first month since July of 2023, so about 2 years, where we didn't see zero, 1% or more up or down move in the S&P 500. That's very rare. And we've had it so far in the first week of August.
And I think the VIX even stayed somewhere around 17. When you think going back to April, it was north of 50,
Right,
right? So it
right.
was a very, very quiet month that way.
Yeah, and that was interesting. And the other thing that was a little bit scary is that was a return of the aggressive stocks. The so-called meme stocks were up. Even the ARC Innovation Fund, I'm looking at returns here, that was up 7.2% for the month. And that thing tanks when the market tanks and can kind of lead when we have an ugly type of
Yeah,
market.
if you ever want to, scare yourself, look at the ARC returns following like the second half of 2020, uh, up through 2022, and then afterwards. It was an easy way to make money disappear.
Right. But I think the reason why the market's held up is even up until today, we have about 75% of companies reporting. I think many more came in after close today. And I'm showing so far about an 85% beat estimates. So they were very positive. Looks like consensus earnings growth is going to be about 8.9%. It was over 10% last quarter. So that was huge. And we also have a big pickup in M&A activity. And that's, so that's those animal spirits we keep talking about seem like they're back in the market.
And IPOs are back. I know last
IPOs
time
are
we were
back,
here, we
right.
talked a little bit about Circle, but I think it was Figma this month.
Figma, yeah.
So it's a very interesting contrast. And I think, even when you take a step back from the markets and you look at the economy, we've had some interesting data points coming out of the economy that's painting a little bit more of a mixed picture. So you would think that there would be some more uncertainty in the markets, but it seems like, to take a Wall Street phrase that we're climbing that wall of worry, and that might be a near-term bullish signal.
Absolutely. Yeah, if you look at Figma, you talked about last month's Circle is very similar movement. So Figma came out and it's kind of an AI-related company, competes a lot with Adobe. In fact, Adobe was looking to buy them out a few years ago. In fact, I think they had to pay Figma a $1 billion breakup fee. But on last Thursday, Figma opens at 33, right? And it closes somewhere like 115. And then after hour trading, it was around, traded at 150. So, people are coming home from work, trading at home and buying at 150. So those people, and it was down about 50% from that the next day or so. So we'll see where that goes.
Yeah, it's definitely reminiscent of some of the trading that was going on during the pandemic.
Right.
And, certainly before my time managing money in the markets, but it also seems with some of the tech and the, the more aggressive stocks that in some ways, this is a little bit reminiscent, I would imagine, of the late 90s, early 2000s.
Absolutely.
I think now these are obviously more mature companies with real earnings, so it's not quite a corollary, but some of the euphoria around some of these themes seems to be, perhaps a little ahead of itself. What do you think?
Yeah, I
of
mean,
that?
I was around for that. I started in the markets in 1994 at Merrill Lynch, and what you had in the 90s and up until 99, you had that bull market run, and basically anything.com went public. So you just, famously pets.com, I think they went public. They traded on the stock exchange before they even sold a product. So it's zero sales. They just had the domain name, and that's that was about it. So now we have AI.com. We should have, instead of naming it Cornerstone Private Wealth, we should have done Cornerstone AI, and we'd probably, maybe we still can.
Maybe we still can.
We can go public there. So that's, but you're right. The AI seems to be more of a useful type of product, and there's a lot of spending going on there. So we'll see where that goes. But the earnings also hit some of the big guys too. You look at Microsoft when they came out with they famously went, they were up, revenues were up, 17% for a huge company, and the stock was up like 8%. Earnings day, another 5% after earnings day, and they went. Now Microsoft is above $4 trillion in market cap, so they're joining Nvidia as the only other company globally that's up at $4 trillion. So I thought it was interesting. You were in Italy, so I was looking at some of the market caps of countries. Forget companies around the world, and you compare these. We have 9 companies that are $1 trillion in market cap. When you compare that to other countries' GDP, so you look at countries look at India with over 1 billion people, it's about a $4.3 trillion market cap with their entire market cap. Look at France, 3.4, Canada, 3.4, United Kingdom, 3.1. So Microsoft, Nvidia are worth more than the UK, the entire UK market, which has about 1,600 different companies. I had to look up Italy because you were there. Italy's only about $1 trillion for the entire market cap, and there's 143 companies traded on that exchange.
It is quite something, and I know it's not a totally fair comparison for a GDP versus a company valuation, but it's
right.
Incredible to see the run up that some of these firms have had. I mean, I remember.
Well, that one's actually not even GDP. That's the market cap of the total companies. Yeah.
And
but
just anecdotally, I mean, remember how everyone was, their minds were blown when Apple crossed $1 trillion for the first time, and now that seems almost quaint.
Right. Exactly. So yeah, 4 trillion is the new 1 trillion, right? So, yeah. Speaking of, some of this, we'll call it speculative trading activity that really picked up in July. Interesting report from Goldman. And by the way, Dan, I have papers all in front of me. You're always organized, and you have it. For this podcast, I'm adding stuff a half hour before. But Goldman had a very interesting report that compared this period to 2 previous periods. One was that you had mentioned the 2000 period from 2000 to 2002. We'll call that the dot-com era. And then and then the second part would be, remember the SPACs that were coming out, the meme stocks that were coming out from post-COVID to February 2001. What you had during both of those periods, you had a lot of speculative trading activity. In fact, we'll go to our first chart of the day. By the way, Dan got me down to 6 charts today, so it will be pretty efficient. But you can see here, this latest pickup, this is in the second quarter here, we're still way lower than we were in February when you had all these SPACs coming out, and still way lower in speculative trading activity to where we were in January 2000. But you could see a big pickup. And one of the things I wanted to explore with you, Dan, is there is also a very big pickup in the demand for private companies. Okay, so we talk about these $4 trillion market caps, but there's also companies that are worth trillions of dollars, and you're seeing like the CEO of Figma. There's a young guy, 31 years old. He became a billionaire. He's worth, with the shares when
I think it's like 6.6 billion.
6.6 billion. So there's a lot of private companies that are worth a lot. In fact, we have a list in front of us looking at some of the private companies. SpaceX is worth 300. Estimate last round that they had was 350 billion. ByteDance 300. OpenAI, ChatGPT, that was 300 billion, but that could have been days ago. It's probably worth $1 trillion by now, right?
No, it's and there's a couple more on there too. Specifically in the AI space as well. I know Anthropic's on that list as well. There's a lot of interest, and you're also seeing just in the marketplace, right? The private markets historically have been reserved almost exclusively for the ultra wealthy, right? Venture capital,
Yes.
private equity, early stage friends and family investing. But one of the other interesting things that had come out of Congress recently is that they've now opened up ERISA plans to
Right.
alternative investments. Now, again, not quite private placement investing or private company investing, but you're starting to move into that area where some of these opportunities that were really reserved are now becoming a little bit more democratized that way. I don't know if that'll be a great thing for investors or not, but it is very interesting to see how this all develops.
Yeah, and it is interesting because you think about back in 2000 or for the last 20 years, what a company would do if you had a company that was kind of like a unicorn that had really a great product. What you'd see is kind of a maybe like a friends and family round,
Yep.
then an A round, maybe a B round, and then they go to the investment banks like Goldman Sachs that we do business with, or Morgan Stanley, and they go public. And that was how they made their money. Now companies are staying private for longer because they can, because you have companies, they have A rounds, B rounds, C rounds, D rounds, E rounds,
Yep.
H rounds, and they become a billionaire without dealing with the quarterly
Yeah.
Wall Street
I mean,
returns.
there's less reporting requirements there. There's less, you're not managing to shareholder expectation as much. So there's some flexibility and some advantages certainly to remaining private. But yeah, up until the past couple of years, that was really the exception, not the rule. Now there seems to be ample private capital available for these companies to your point, to stay private for longer or maybe indefinitely.
And there's a couple on the list from the Philly area, right? You mentioned,
Yeah,
yeah.
we have on there GoPuff, which is
So-called
everyone's familiar
private.
with DoorDash or Uber Eats, but GoPuff was kind of a pioneer in that space, with rapid delivery of local products or goods, and then also Fanatics for any of my sports fans out there. So very interesting to see. I mean, there's some real household names that are still private and exceptionally large companies. I mean, even I think one of the lowest ones on the list was Discord, which is a
Mhm.
big communications platform. I think that was 15 billion, which is pretty incredible.
Yeah, you're right. Yeah, GoPuff's on the list at 20 first largest, and that's about 15 billion. So probably another young kid from Philly that's a billionaire there, right, on that list. And then, yeah, the FanDuel, yeah, about 32 billion dollars. So somebody's a billionaire there, right? But
Incredible.
the question we're getting from clients there, and it's a difficult question, which is how do they get in, right? So there's what we've done historically, and we do have clients that have private equity funds. And the interesting thing about private equity funds is that's a way to do it. And what you can do is you can kind of spread your risk out, go into a fund, KKR, Apollos of the world, Blackstone, let them pick a series of private companies for you is probably a safer way to do it.
Yeah, I would say, in that space too, diversification, in the same way that you would diversify your normal investments, looking at these alternative investments and not putting all your eggs in one basket is incredibly important because, for every successful private company, an Uber that goes public, or a Facebook or whatnot. I guess Meta now is how they are called, but there's just as many that are on the dustbin of history, so to speak, that didn't work out. So it is you got to fight the urge to kind of get caught up in that and want to
Right.
chase the what's the exciting news of the day, but uh, it's certainly becoming more and more accessible.
Absolutely. So if you look at another interesting chart in the Goldman Sachs report, what they looked at is average S&P return since 2005 that we're looking at. And what you have here is periods of time following when you have this increase in the speculative activity. There's 21 periods where you have this pickup. And what you see, which is interesting, is you see when periods of time when you have this speculative in the light blue here, you see in the next 3 months, the returns for those asset classes the market in itself tends to do pretty well, right? So it goes up higher in 3 months, it's higher in 6 months, higher in 12 months, but eventually it crashes out. You see the 24-month return is way lower than other periods where you don't have the speculative activity. And then 3 years later, it's way lower. So that's when the other shoe drops, right?
Definitely. And, it just goes back for any investments that you're selecting. there's always an opportunity to make money on maybe a lower quality
Hmm.
company in the short term. But longer term, right, having strong fundamentals, a real business, strong cash flows, is really what carries a day longer term from an investing standpoint. And when we're working with clients, we're investing for the long term. We're not, trying to trade and make a quick buck for them. So it's always interesting to see the market dynamic and how retail investors are out there, buying an AMC movie theaters or a GameStop or what have you, versus you know tried and true or a more boring type of investing. I mean, look at a stock that had run up precipitously over the past couple of months, like a Berkshire Hathaway.
Right.
You could not invest in more boring companies if you tried.
Right.
But that just goes to show you having that long term, steady, stable basis can produce exceptional results as well.
Yeah. So the advice to clients there is keep doing what you're doing. Conservative growth is the right thing for most people. So let's get back to the Washington fights because it's we are the Federal Reserve in the July meeting. They held steady, okay, but it was quite a change because we had a couple dissensions
Yeah.
among the Fed, which was interesting. And then we had a Fed Governor Kruger announce that she's leaving. In fact, she didn't vote at the last meeting. And I think the reason for it behind the vote, not voting, is that you have to stay on for, I think, 6 months,
Yeah.
if you from the time you place your vote. So that's going to leave a vacancy at the Fed. We have two dissenters already. We have, Trump's saying he's going to appoint somebody by this Friday. We're doing the taping on Wednesday. What are we, Wednesday, August 6th. So he's saying he's going to announce a Fed replacement on Friday. We'll see if that happens. So that's three potential dissenters there. Do you think the Fed's ready to do a kind of a dovish pivot?
The betting money on Wall Street right now is for a September cut. I think
Yeah.
the most recent data I saw was somewhere in the 85 to 88% likelihood.
96% today.
Yeah.
on-
So
Yeah.
it's like it's gone. I think it's almost a certainty at this point, especially, we had the July jobs data that came out. And I know the Bureau of Labor Statistics has been in the news, and we can talk a lot about why that particular institution is so important. But part of the data that they're producing, not only the jobs report, but also CPI, and these are figures and data points that the Fed actively uses to set their policy. So having a report come out like that, I know the president didn't love that jobs number, but seeing the employment rate tick up and the job market potentially weakening, I think that's part of that data dependence that Jay Powell's talking about. I would not be surprised at all if we saw a September cut. The sizing of that,
Yeah.
that's up for debate. But
Yeah, and you saw that probability of a September cut go up a lot,
Yeah.
right, on Friday after that report. So it was, Trump, went after some people there, but it was better for what he wanted.
For what he
which is
wants, yeah.
For lowering.
And it was
interest rates.
interesting. I mean, correct me if I'm wrong here, but I believe too the two dissenting votes on the Fed were both Trump appointees.
Yeah.
And he's going to put a third, governor on there. So I do think you'll start to see, at least the attitude of the Fed probably get a little bit more in line with what the administration's looking to do.
Yes, yeah. Christopher Waller and Michelle Bowman
Bowman.
were both Trump appointees from Trump 1. So obviously the third one's going to be there. So if you look at it, implications from the investment markets, if interest rates go down, although remember the Fed is tinkering with the very short-term federal
Yep.
funds rate. It doesn't always move the 10-year the way you might want. I have a lot of clients that are clamoring for, we need lower mortgage rates and, not so much credit card rates, but they're tinkering in the short end. Doesn't always correlate with mortgage rates.
Yeah, and that could have really significant implications for the economy as well, because you're starting to see, for the first time in a while, like housing inventory actually start to pile up.
Right.
So
Really are.
if you get even a modest amount of movement on the mortgage front, I think you start to see maybe the dynamics of right now. I wouldn't say it's a buyer's market by any stretch, but you might see more of that pressure start to build there, and see some home purchases start to tick back up again.
Yeah, and I think it's a cycle. It's very hard for new people coming into the housing market at these higher rates and higher prices. But you look at the New Jersey beach areas, you're talking to a person who sells real estate down there, and they're pretty much when you're talking about Avalon and Stone Harbor, they're talking about just cash deals. People that have tons of equity coming out of other properties, and that's helping to prop that area up. But
Absolutely.
but if the Fed, the thing is we do have the wind at our back probably right now because we still have strong earnings, and if we enter an environment where interest rates really are decreasing, that adds a positive element to the bond market because you could have a total return that's positive because you could have some appreciation to your bonds, and it certainly helps the stock market.
Yeah, I think the one kind of factor we have to keep, almost focusing back in on is the tariff front, right? That
Right.
certainly is another component that uh, is highly likely to push rates, lower in the near term when you start to see some slowing down in the economy, but also inflationary at the same time. So the Fed is kind of in a really tough spot,
Right.
right? They're they're getting grief for being too slow. But if you start to see inflation really tick back up again as these tariffs really start to take, form and kind of circle and flow into the economy, they may not be able to cut.
Right, absolutely. So I think, but this year, what it does for clients, I was telling a client yesterday, it's just another example to really to think long term. We talk
Yeah.
about that all the time on the podcast because this year, I mean, we had wild moves. We had a 4.7% increase in the beginning of the year, followed by a 20% decrease, followed by now we're at what, 28%
Great.
increase, all within the first 6 months of the year. Could you imagine if you tried to trade in and out of that? I love what Warren Buffett always says that, he has said that more money is lost preparing for the next bear market than it ever is during the bear market itself, right?
Yeah. I it's just a reminder of you have to have a plan. You have to in times like this, it's easy in a month like July where the market's just kind of in a trajectory, slowly grinding upward. But really think back to the earlier parts of the year and that kind of feeling of unease and uncertainty. And those are the times where having a good financial plan in place and kind of focusing on, what are my longer term goals? Am I positioned for those goals? Not necessarily, you know, do I have the most current allocation or most tactical stock allocation? Um, you know, am I positioned in a way that makes sense for my family, for what I want to accomplish? And having that kind of North Star to go back to, I think helps you, you know, not be overly exuberant when times are great and not
Right.
be overly scared when we have a situation like an April, May timeframe where, who knows where the markets are going.
Yeah, it's such a great point, and we can go back to that when clients call, and obviously, we're preaching to the choir in so many cases because we had clients that we
Yep.
had that conversation in April, and clients were nervous. But for the clients that most recently had done a longer term financial plan, you can kind of go right back to the plan and say, we did a stress test. We even account for 2 negative years, and we can do that at any time with your financial plan. It's a good time to kind of go back to that and take a long term perspective on things.
Absolutely.
Let's hit a couple more charts because I think this one here is from the great one from J.P. Morgan. I love, and by the way, this is a plug for J.P. Morgan Guide to the Markets. It's available to the public. You can just Google J.P. Morgan Guide to the Markets and get their slides. This is one of them. But what this does, this chart is very colorful and interesting. But what you see here is basically compares the bear market since 1973 that occurred. Okay, and what you see down below the line is the bear market, and I think it's a great visual. And then what you see above the line in the corresponding same color is the bull market that came after the bear market. And what you notice about the chart is that the bull markets are a lot longer, right? Generally, just take a look if you want to, prove that to yourself. Google your birthday and whatever year you were born. Say where was the Dow Jones Industrial Average the day I was born? Right, that can put things into perspective. It's pretty low if you're pretty old, and it's pretty high now. But what you'll see is the amount of months. Basically, a bull markets last typically about 70 months, and the average return to bull market is about 221%. You see it here, and bear markets last on average about 14 months. and they decline about 38%. That's pretty painful, but the only way you get that 221% is to go through the 38%.
Yeah, absolutely. And again, the way that bull market or bear market presents itself is very different every time. I mean, we try to look and go back and check historical periods and different scenarios that happen, whether it's wars or economic scares or what have you. But it's always a little bit different, right?
Right.
And it's always the pain points, the causes. So again, it's you're never going to guess it, right? You're not going to be the person that, the Michael Burry that buys credit default swaps and becomes
Right.
a billionaire. For the average investor, your best bet is really just have an all-weather portfolio, be able to sit through, take enough risk that you're able to go about, function, live your life, cover the necessities and not, let it consume you. Right. And I think by doing that, by having a portfolio that's representative of your risk and that's aligned with what your goals are, you're less likely to try and make those big changes. And that way you can participate in more of the bull markets and not sell out at the bottom of the bears.
Right. Time in the market, not market timing. Right?
Correct.
That's great. So another chart, second to last chart here, is the other thing that's holding everything up right now, continues to be from these earnings. And we have to touch on it almost every call, is the spending into AI. I don't know what they're spending this money on, but if you look at this chart here again from JP Morgan Guide to the Market over here, you see, just take a look at the amount of spending, capital expenditures from just the four largest, Google, Amazon, Meta, which is, Facebook, and Microsoft. And you see where that's gone. Just take a look at the size of the chart. If you're not looking at this live and you're listening to it on the podcast, just imagine a bar chart with the numbers going up a lot, right? Because, and then the earnings, and the earnings reports that come out, they're just spending more and more billions and trillions of dollars on AI as far as the eye can see. And it's almost like they measure on these calls the amount of times that people mention AI. You can't, no matter what business you're in, you have to have an AI policy. Probably two things you have to have. You have to have an AI policy, as Apple learned, right, that their stock's been underperforming because they haven't been able to articulate an AI strategy. Their stock is up today on some news of that. And then you have to have, obviously, cyber security spend too, right? If you're not protecting data. So.
Well, it's interesting as well. We had that period, a little bit last year where you started to see, to your point, those AI mentions wane a little bit, and it seems like we're right back in the thick of it. And there's a lot of ancillary businesses, or I should say complementary businesses, that are getting a lot of focus. I mean, I don't know in my lifetime if I've heard as much talk about nuclear energy or the grid, and all of the the various energy needs that we're going to have. I mean, you saw Microsoft inking deals. You saw data centers going up. I mean, I think they put there's a data center going up in North Carolina. I think it's a $500 billion investment, 1,200 jobs. Think about the amount of power that is necessary, heating and cooling, et cetera. So it is, whether you believe in the promise of AI in terms of, how it's going to change your life or not, it's real. It's here to stay. Companies are putting their money where their mouth is, and they are spending incredible sums. I mean, tens of billions of dollars annually to move this forward.
Right. It's exciting. So that's the positive. That's been helping earnings. And then maybe the negative. And this last slide that we have for this podcast is on tariffs. And we've shown this before, but we have it updated. This chart gets updated every week because we don't even know where the tariffs are going to be. But what has the market kind of nervous? And you look at the tariffs going back to 100 years. This, is pretty much the highest ever. Now, you could see the chart last month. We had it with,
a chart billion.
We had it at 30%, right? Now it's on average from JP Morgan is guessing the average tariff rate globally is going to be something like 15.8%. That's blending in everything that we can see. But you can imagine it's difficult for the Federal Reserve because they don't know what's going to happen. The government really doesn't know what's going to happen. What we do know is that we're raising some money through the tariffs. So that's been probably more than it's been expected. But companies are still, playing more wait and see.
Yeah. I mean, one of the things that I think has not showed up in the data yet, but you're hearing more and more, and this has really been, for the past year or so, but companies they're not hiring, right? And
Right.
you're seeing a lot of these return to office mandates that are kind of, a convenient way to do forced reductions
Hmm.
without having to, outright come out and say you're doing layoffs. So the job market is telling a little bit of a story that this uncertainty may be impacting things, maybe more than the headline numbers are suggesting. It'll be interesting to see how that, how that works itself out. I almost feel like companies, whether the tariff regime goes in as harshly as it, currently is anticipated to be, or it pulls back, is less relevant than just knowing what it's going to be.
Right. Absolutely.
And gosh, to your point, not knowing where the tariffs are going to be. I mean, if you asked us last month, were the U.S. and India, on a path to have a really productive tariff conversation, it was almost a definitive yes. And now, you're looking at that, and it's kind of almost like a baby version of what he did with China, where he's
Absolutely.
talking about really ramping up tariffs in a very punitive way.
And if we don't have China, we're going to need some more manufacturing in India. So that relationship's going to be critical. And also, if you look at demographics, China is very much an aging, and then the rising middle class in India is increasing.
Exactly. I mean, so it's a curious decision. I understand. It's kind of convenient timing to focus on, the Russian oil aspect of it, and while I agree that certainly, producing or allowing the war in the Ukraine to kind of go on longer than maybe it otherwise would,
Right.
that's also not a new
Right. That's not new.
piece of data there. So it's kind of curious to see, how this develops. Anyone knows, but it's certainly very important, and it should be paid attention to.
Great. So let's wrap it up. So we're sitting here in early August, and I think if you're going to look between now and our next podcast, what you have is, we're in August. August is a quiet month. The government, they're home. They're
Yep.
not working. A lot of people are on vacation. We talked about last month, July tends to be a seasonably positive month. Not so much for August and September. So we're entering a little bit of seasonably difficult period. On the other hand, I like to go back and have been watching closely Tom Lee from Fundstrat. I was watching his podcast this morning, and he was talking about still the hated V-shaped rally. So you still have a lot of cash on the sideline, something like 7 trillion in money market funds,
Yep.
which is very much a high. And then what happens is the market kind of climbs that wall of worry as the earnings come in better than expected. There's people still funneling money in, so you have that momentum there. Who knows where it's going to be between now and a month from now? But I think it's a good time to, again, revert back to your financial plan, keep track of your asset allocation. Don't get over your skis and chase stuff that you don't have to chase when you have things that are giving you solid returns on a year-to-date basis.
Yeah, and take a look at your equity allocations. I mean, they may have gotten a little bit out of whack recently.
Right.
It's maybe not the time to do wholesale portfolio changes, but again, you want to stick to your targets. And if you've gotten a little heavy on the equity front, if it makes sense, it might be time to take a little bit off the table there. Yeah, but it just makes sense to look at your allocation again, and again have a conversation with us. Right? It's a slower time of the year. We're available. Let's take a look.
Yeah, and the other action item, I was talking to 2 clients about this today. We've been pleased with the money market rates. So we have a lot of you in the money market rates that were above 5%. Now they're still above 4%, but it's been declining. So if the Fed does cut rates and we see a move in interest rates down, we might want to shift some of that money into some other things. I was looking at, there's some pretty strong ETFs, shorter term ETFs. You get a higher yield and maybe get a little bit,
Yep.
you're in a better position than a declining money market rate. I think if the Fed cuts 3 times as expected right now, the remainder of the year into the beginning part of next year, and you get that money market rate in the threes, you start to compare the money market rate in the threes to taxes and inflation. Your real return after taxes and inflation is pretty low or negative
Yeah.
in the money market. So not a great place to build wealth.
No, definitely not.
So we'll take a look at that. Other than that, it's a good month to do what Dan just did, take the family to
Yep.
Italy, and hopefully everybody listening to this podcast will enjoy some time off and some time with family. So until next month, we'll see you soon. We're around if you need us.
Thanks, everyone.
Cornerstone Private Wealth is an independent financial firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Cornerstone Private Wealth Partners provides all investment advisory services through Concurrent Investment Advisors, LLC, an SEC-registered investment advisor. Concurrent Investment Partners, LLC, DBA, Cornerstone Private Wealth are not affiliated companies. The items discussed are the views of the presenters and not of Concurrent Investment Advisors, LLC. The information provided in this podcast is for informational and/or educational purposes only and is not in any way to be considered investment advice nor recommendation of any investment product. Past performance is not a guarantee of future results. Investments can fluctuate and when redeemed may be more or less than originally invested. Concurrent Investment Advisors, LLC and Cornerstone Private Wealth is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. Please consult with your attorney, accountant, or tax advisor based solely on your individual circumstances.